Hi, everybody, and welcome back to video number 3 in Chapter 8. And when we left off, we were looking at this quick check 5. Now, just to go back so you see the numbers here, we were looking at the direct labor budget, first of all. And now, what we're going to do is, what would the total direct labor cost for the quarter be if the company pays time and a half for all hours worked by employees over 2,000 per month? Now, if we go back to that calculation here, the answer would be 52,000 because we didn't work over 2,000 hours in April or June, but we worked 300 hours over 2,000 in May. So that 300 hours would be paid at $10 for those hours, and then another 300 hours would be paid for at $15 per hour. Okay. All right, now we're going to prepare a manufacturing overhead budget. That usually is one of the more difficult ones to prepare. So at Royal, manufacturing overhead is applied to units of product on the basis of direct labor hours. And the variable manufacturing overhead rate is $20 per direct labor hour. And our fixed manufacturing overhead is a flat $50,000 per month, which includes $20,000 of non-cash costs. That's normally depreciation, and it is here in this case, of plant assets. Let's prepare the manufacturing overhead budget. So here is from the direct labor budget, we know our direct labor hours, and we can multiply that through times $20 to get our variable manufacturing costs here, and then our fixed manufacturing costs, and our total manufacturing overhead costs. And to get the cash that we're paying for that, it's good to back out the non-cash costs here of $60,000 for the quarter. So the predetermined overhead rate per quarter is going to be the $251,000, not the $191,000, but the 251,000 hours divided by the total direct labor hours of 5,050. And that gives me a predetermined overhead rate of $49.70 per hour. Okay. Now, we're going to take a look at the ending finished goods inventory budget. So here we had the production cost per unit here, and the direct labor cost, and the manufacturing overhead. So our cost per unit is $4.99. The budgeted finished goods inventory was 5,000 units. And that multiplied through by $4.99 gives us an ending finished goods inventory of $24,950. Now I can take a look at taking that from the production budget, which we just did, to come up with that $24,950. Okay, let's prepare a selling and administrative expense budget. Now, the only thing with selling and administrative is for selling, there's often a commission associated with some of the selling that's done, whereas our administrative budget is almost all fixed costs. So let's see what Royal did. Here at Royal, the selling and administrative expense budget is divided into variable and fixed components. The variable component, it for selling administrative is 50 cents per unit sold. I'm going to assume that that's a commission. The fixed selling and administrative expenses are $70,000 per month. So the fixed selling and administrative expenses include $10,000 in costs, primarily depreciation, that are not cash outflows in the current month. So again, depreciation is a non-cash expense. So let's prepare the company's selling and administrative expense budget. And here we have our budgeted sales, our variable sales and administrative rate of 50 cents. And was that given? No, yes, given in the problem here for variable. And that gives us $10,000 of variable expenses. Now the fixed is $70,000, so that totals $80,000. We are going to back out the non-cash expenses because we're going to need to know the cash effect of the sales and administrative expenses. Okay, and we can do that. We'll take a look at that for the quarter. I'll let you do that on your own, and then we can circle back to that. That's going to be an answer of $230,000, and the way we get that is simply multiplying this through for May and June the same way we did April, and add them across to get $230,000 for the quarter. Now that's cash. Recognize, of course, that our total expenses are $30,000 more than that. Okay, now we're going to prepare the cash budget. Always the most difficult budget to prepare. And again, it's only as good as your sales forecast. So a lot of effort should be placed in doing that as well as you possibly can. So the format of the cash budget is divided into 4 sections. We have our cash receipts, and that lists all the cash coming in, excluding any cash received from financing. Call it cash receipts from operations. And then cash disbursements, same idea, except this is cash payments, cash out, excluding repayments of principal and interest. So that's going to give you the cash excess or deficiency in determining whether we're going to need to borrow money or even sell stock, or if it will be able to repay funds previously borrowed. And then in number 4 here, the financing section details the borrowings and repayments projected to take place during the budget period. So what we do is we assume the following information for oil. 1, it has a cash balance of $40,000 to start off April. Number 2, it maintains a minimum required cash balance of $30,000. Now you might say, whoa, that's a lot of money to keep as a minimum, but the budgeting process is not perfect. So we want to be sure we have this conservatively stated as much as possible. In my case, I always tried to maintain about $15,000 as a minimum. But if you have a lot of unexpected or poor budgeting, let's call it, that can disappear very quickly. Okay, then we maintain a line of credit of $75,000, just like your credit card would be for your person. That would be money that you can draw down or pay back as the company needs materialize. Then the line of credit terms include borrowing on the first day of the month and repayment in full, including interest, at a whopping 16% on the last day of the month. Then we're going to pay a cash dividend of $49,000 during April. And it's going to purchase here $143,700 of equipment during May and $48,300 during June. And we buy both of those with cash. Okay, so if we put this all together, here is a schedule of expected cash collections. Okay, $170,000. And that's our total cash available. That comes from way back in the sales budgeting. Okay, then our cash disbursements for materials, direct labor, manufacturing, overhead, selling, equipment, and dividend is from the schedule of expected cash disbursements here for materials, etc., and from the manufacturing overhead budget, and from the selling and administrative expense budget, and then the equipment purchased were a given, and dividend was a given in the problem. All right, so now you can see we have a deficiency of $18,000. The difference between $228,000 and $210,000. And so how are we going to live with that? We either have to borrow it or sell stock. In this case, we've chosen to borrow it. So we're going to borrow $48,000 because Royal's minimum required cash balance is $30,000. And the company must borrow $48,000 on its line of credit. Okay, there she is. So the ending cash balance for April then, of course, becomes the beginning cash balance for May. And there we go. So we would need to ripple that through May before we're going to know what June is. So here's our minimum balance of $30,000. We had a really good month collection-wise, and so we had a cash excess of $40,000. Now, what we're going to do is we cannot pay the full amount of its line of credit in May, but we can ease it down a little bit. And what's the excess deficiency of cash available over disbursements for June? Well, what we would need to do is check to see $130,500. And we have to walk this through here. Here's our $40,000. And then what we borrowed in April is going to be repaid on June 30th with interest. So there's the $48,000 plus the 16%, but it's only for 3 months, April, May, and June. And that comes out $1,920 of interest. So we add that to the repayment cost, and that tells us that we are going to have $49,920, and we're going to subtract that from this excess of $130,500, and that will leave us with an ending cash balance of $80,580, and that will be the end of the quarter. So here's the quarterly numbers, and away we go. Okay. So now we're ready to do the budgeted income statement. Here, once the cash budget's done, we would need to know the cash before we're going to know how to do the budgeted income statement, because we need to know the interest expense from that cash budget. So now Royal can prepare the budgeted income statement. And here the little beauty is, budgeted income statement. Here's our sales. Here's our cost of goods sold, 100,000 units at $4.99. A gross margin, selling and administrative expenses, our operating income, our $1,920 of interest expense leaves us with net income of $239,080. Okay, that looks like a good place to stop this video. And when we return, we'll take a look at preparing the budgeted balance sheet. Until that time, bye for now.